morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at some financial results from the conglomerate sector, two of the region's largest conglomerates. We're speaking, of course, about Massy Holdings Limited, rather, as well as Grace Kennedy Limited. Both groups would have reported fairly decent results. Let's take a look at what the financial groupings would have reported and what investors might expect in the coming months ahead. Turning firstly to Massy Holdings Limited, or Massy, the group would have reported for their 9-month period ended June 2025 an earnings per share result of 25.3 cents, which was a 15.7% improvement from the 22 odd cents recorded in that prior comparable period of 2024. Earnings from continuing operations were up also 17.4% from 20.9 cents to 24.6%. Driving this performance was a very modest increase in revenue from continuing operations of 4% from 11.39 billion to 11.85 odd billion. Operating profit after finance costs up 32.3% from 603 to 798 million, with profit attributable to equity holders ultimately increasing at 15.7% from 432.6 million to just about $500 million for that 9-month period. So certainly makes for good reading for Massy investors at this particular point in time. Now, driving that result in terms of our profit before tax contribution by segment were the major sectors of, or major business lines of Massy Holdings Limited, which would involve integrated retail increasing in terms of PBT contribution from 456 million in that 9-month period of 2024 to 513 million in 9 months of 2025, roughly 12.5% increase. Gas products also improved roughly 12% from $246 million to $275 million. There was some marginal declines in the motors and machine segment from 141 to 128 million, a roughly 9% decline. And financial services also declined from 66 to $57 million there. But from another positive driver for Massy's performance would have been a recovery in profitability margins. And here we can see that profit before tax margin in that pink line would have rebounded from 6.3% in that 9-month period of 2024 to 6.8% in the 9-month period of 2025. Similarly, operating profit margins had a very strong rebound from 5.3 to 6.7%, and profit after tax margin improving also from 4% to 4.5%. All of these profitability margins trading at the higher end of their recent ranges from the 9-month period of 2021 coming forward to the 9-month period of 2025. So what does that mean for investors? Well, impressively, Massy is recovering a bit in terms of their ability to convert every dollar of revenue generated into profits for their shareholders. And from a geographic diversification perspective, also some important and positive changes. Here we can see that the reliance on the Trinidad and Tobago market has continued to moderate from 40% in the 9 months of 2022 to just about 33% at the most currently concluded period. We also see that Barbados has been relatively resilient in terms of its geographical diversification in terms of profit before tax at around 14%. Marginal growth in the Eastern Caribbean segment moving from 11 to 12%. Guyana continues to grow fairly strongly from 26 to 27% over the comparable periods. A slight decline in terms of Jamaica's contribution from 11 to 8%, USA holding steady. And the Colombia also improving just marginally from 4 to 5%. So at a price of $3.90, Massy is trading at a price earnings ratio of 10.6 times, which is below the sector average of 11.9 times, and offers investors a fairly attractive, well, the most attractive dividend yield, in fact, on the conglomerate sector of 4.5%, which is significantly above the sector average of 2.4%. So with that modest revenue growth in mind, those recovering or higher profitability margins, and that continued enhanced geographical diversification away from its anchor market, if you will, was maintaining an overweight rating on Massy for the time being. Turning very quickly to GKC, or Grace Kennedy Limited, well, the group would have reported a lower earnings per share figure, actually, of 4.3% decline, in fact, from 19.4 cents per share, TT equivalent to 18.6 cents. There was, however, a revenue growth of 5.5% from 3.68 billion to 3.89 billion. However, ultimately, net profit attributable to equity holders would have declined to 6.1% from 206 million to just about 193.5 million TT equivalent after all effects of expenses, etc. When we take a look at contributions to PBT, or profit before tax, by segment, we can see that there were some notable changes, fairly modest improvement in food trading from 189 to 191 million TT equivalent, or just about a 1% increase. Again, these are before eliminations. Money services declined fairly significantly, about 26% from 64 million to 47 million TT equivalent, reflecting a more challenging remittance environment, particularly in the Trinidad and Tobago jurisdiction. Banking and investments fairly stable at 26 million TT equivalent in that green segment, and insurance improving just about 14% from 43 million to 49 million TT equivalent. Here we can see in terms of profit before tax, or profit before tax margins and profitability margins rather, that there was some deterioration in operating profit margin from 7.6 to 6.7%, while profit before tax margin also trended down from 7.7 to 6.9%. In contrast to Massy, these profitability margins are trading at the lower end of their recent ranges from the half year of 2021 coming forward to the half year period of 2025. From an earnings per share basis, on a trailing 12-month basis rather, we can see that there has been relative stability in GKC's earnings per share on a trailing 12-month basis, and that has also been reflected in a relatively stable share price, with trailing price earnings ratio hovering at just about between 10.3 to 10.5 times over the past 3 consecutive periods. So at a price of $3.65 per share, GKC is trading at a price earnings ratio of 10.5 times below the sector average of 11.9 times, with a dividend yield of 2.8%, which is above the sector average, but fairly average in terms of the larger scope of dividend yields on offer across the Trinidad and Tobago Stock Exchange. So with that steady revenue growth in mind, however, noting that GKC does remit its dividends in US dollars, and relatively fair valuations, Bourse is maintaining a market weight rating for the time being on GKC with a stable outlook. But that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse. Email us at info@boursefinancial.com, and of course you can check out our website where all of our research is absolutely free at bourseinvestment.com, and you can catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. So until next time, stay safe, happy investing, enjoy your Independence long weekend, and we'll see you again on the Bourse Report.